Nick Routley from Visual Capitalist has recently published a great chart that uncovers the wealth composition of individuals with net worth from 0 to 10 million US dollars. A few points here come to mind as the never-ending debate about asset mix in the financial industry continues. Wealth is assessed in blocks of assets, some of which turns out to be more common between low and middle income, and others seem more common with the ultra-high net worth individual. Middle income households account for the majority of the population, followed by the upper income, and finally a point of a percent is the ultra-rich. In brief, the main asset classes pictured summarize the calculations collected by Edward Wolff in a paper published in 2017. The classes are principal residence, pension accounts, liquid assets such as checking accounts, saving accounts, different kind of mixed assets such as precious metals and collectibles, stock, securities, mutual funds and trust, business equity and real estate. These are the main asset classes. As the individual moves up to the wealth ladder, certain trends seem to appear. Primary resident weighs less and less, from an astounding 61% to a mere 7% for the ultra-rich. Pension accounts also decrease in weight, as security and business equity increase dramatically. Ultra-wealthy in particular have about 80% of their net worth tied in financial assets or real estate. Here's something to think about. Is wealth necessarily built in sequential blocks? Which also can be rephrased as, does wealth accumulation requires the linear progression that is shown by data? In other words, do we need to progress from residence equity to business equity necessarily? A number of financial planning literature textbook stresses the idea that home equity is the primary desiderata when it comes to wealth creation. Without a doubt, home equity is a good form of equity, but as we speak, fortune is the tech industry have been created by progressing non-linearly across asset class. Businesses are created, grown and sold at a speed that was never possible before. Securities and financial instruments have never been as accessible as today, and financial literature is available to explore like it never was before. So no, I believe that wealth creation is a non-linear process that is powered by technology and scale economies. Diversification of assets holds as a principle and represents one of the longest existing tenets for effective risk management and wealth creation. Business equity is urgent. The higher the net worth, the higher the portion of business equity to total asset. Individuals with net worth of 500k plus range between 25% to 49% of total asset held in business equity. This shouts to our faces that wealth is created by business and seems to be the most interesting takeaway. Now stop reading this and start a business. Go right now. Traditional investing has a special position as well, ranging between 18% and 31% of the assets held by individuals with a net worth of more than 500k. Financial assets maintain stability and represent a favorite asset class of the wealthy population. An aspect that the infographic is not taking into account is the household debt analysis that is covered by Edward Wolff. He uses the debt over net worth ratio to unveil some interesting insight. The ultra-rich have a ratio of around 2.4%, upper income 10%, and middle third quintiles, which is the middle income and lower income combined, 58%, almost actually 59%. This does not mean that debt is evil, but it definitely shows that people that have built fortune understand the risk profile of debt and use it accordingly.